Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Wednesday the 20th of March, and today is the United Nations International Day of Happiness. According to the UN, happy societies are healthier, more productive and more peaceful. We're happy. I hope you're happy today as well. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Japan's central bank raised interest rates on Tuesday for the first time since 2007, ending the world's only negative rates regime on early signs of robust wage gains this year. The Bank of Japan also ended its yield curve control policy and halted risky asset purchases. Despite raising rates, the BOJ cautioned it's not about to embark on aggressive rate hikes, anticipating that accommodative financial conditions will be maintained for the time being. Japanese stocks notched gains on Tuesday following the BOJ's decision. The Nikkei 225 whipsawed before adding 0.7% to close just above 40,000. The Japanese yen weakened 1.2% against the dollar to a 4-month low of 150.92 yen per dollar. In another monetary policy meeting, the Reserve Bank of Australia held its benchmark rate at a 12-year high of 4.35% for the third meeting in a row. And they said while recent data indicates that inflation is easing, it remains high, the bank said in a statement, adding that its board expects that it will be some time yet before inflation comes down to the RBA's target range of 2 to 3%. Nvidia has unveiled its latest artificial intelligence chip, which the company claims can do some tasks 30 times faster than its existing market-leading hardware. Described by Nvidia as the world's most powerful chip, the Blackwell B200 GPU has 208 billion transistors, compared with last year's H100 chip, which has 80 billion, and that's a measure of its increased power. The firm has an 80% market share and hopes to cement its dominance. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment. And with a view from Japan is Tokyo-based journalist and author William Pesek. And if you want to get in touch with any questions or comments, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks rose Tuesday as the Federal Reserve kicked off its two-day policy meeting. The benchmark S&P 500 climbed 0.6% to close at 5,179. The tech-dominated Nasdaq Composite gained 0.4% to end at 16,167, and the Dow gained 320 points, or 0.8%, to close at 39,111, its best day since February the 22nd. Chipmaker Nvidia climbed 1.1%, recovering from an earlier loss after CEO Jensen Huang unveiled Nvidia's latest AI chip, labelled Blackwell. Some Wall Street firms, including Goldman Sachs, boosted their price targets on the stock following the event, citing Nvidia's compelling position as a key AI leader. US Treasury yields dipped broadly. The rate on the benchmark 10-year Treasury was down 5 basis points at 4.29%. The US dollar index touched a 3-week high on Tuesday morning. The gains moderated in the afternoon to a 0.2% rise. All major Asian currencies registered losses against the dollar as currency traders took into account fewer Federal Reserve interest rate cuts this year. Gold settled 0.1% lower at $2,158 an ounce, weighed down by a stronger dollar. And the oil rally continued on Tuesday. Brent crude oil settled 0.6% higher at a 4-month high of $87.38 a barrel. Bitcoin fell 5.4% for the day to $63,650 after dropping close to $62,000 in Asian trading. In Hong Kong, the Hang Seng tumbled 208 points, or 1.2%, to finish at 16,529 on Tuesday, more than reversing the small gains from the day before. The Hang Seng Tech Index closed 1.8% lower. Tech stocks were weaker as the EU mulls joining the US in reviewing the risks of Chinese legacy chips and is flagging potential risks to national security and supply chains. The Shanghai Composite fell 0.7% to close at 3,063, with mainland stocks retreating from multi-month highs as weak sentiment pervaded the market despite some upbeat economic data earlier this week. Futures markets pointing to a gain of about 60 points for the Hang Seng at the open this morning, projected to open around 16,590. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have our regular Wednesday morning commentator, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Morning to you, Enzio.
Good morning, Peter.
And also with us is Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management in Hong Kong. Morning, Marc.
Good morning, Peter.
Well, let's start with the Bank of Japan. Japan's central bank raised interest rates on Tuesday for the first time since 2007, ending the world's only negative rates regime on early signs of robust wage gains this year. The Bank of Japan also ended its yield curve control policy and halted risky asset purchases. Despite hiking rates, the BOJ cautioned it's not about to embark on aggressive rate hikes, and it anticipates that the accommodative financial conditions are going to be maintained for the time being. The BOJ set its new policy rate in a range between 0 and 0.1% from the previous minus 0.1%. That brings an end to an era of negative interest rate policy for the first time since 2016. The BOJ also removed its 1% upper reference level on 10-year Japanese government bond yields, which the central bank has employed to target longer-term interest rates by buying and selling bonds as necessary. That effectively ends yield curve control, and the BOJ also said that it would discontinue purchases of exchange-traded funds and Japan real estate investment trusts. Enzio, we were discussing this on the programme yesterday, but in the end, the BOJ was rather bold, wasn't it? It didn't just raise rates, it's ended yield curve control, it's also ended risk asset purchases such as stock ETFs. Why is it going all in?
I think because it just wants more flexibility. Just as an aside, it's interesting that the Bank of Japan wants to push its rates above 2% sustainably, and the Fed wants to depress them below 2% sustainably. That's just an aside. I think all of this is about very much the yield curve control is about the liquidity and the economic clock. If the Bank of Japan is concerned about the yields getting too low, then it will have to, if it starts buying bonds to increase the price of the yield, and that's, sorry, I'm getting all muddled now. It just wants to increase liquidity by buying bonds. It gets bonds and gives money into the system. And I think that allows the Bank of Japan more flexibility to keep on increasing what I call this excess supply of money in the markets by getting bonds and giving more liquidity into the markets. So by buying bonds, it is actually increasing the excess supply of money in the system, thus promoting the stock market. I think that's what it wants, along, of course, with inflation.
Isn't it? It's removing liquidity really though, isn't it? Because it's ending the yield curve control policy, and it's also ending its purchase of exchange-traded funds, which it buys every time the market dipped by about 2% or more. In came the Bank of Japan to buy it, although it always denied that was its official policy, but that's in effect what it did until last week.
Yes, I fully agree with you on the second point. I suspect that the ETF purchases, for instance, were more at the margin, though, Peter. I don't think that was the main thrust.
Marc, why do you think the Bank of Japan's being so bold here?
If I may, I would say that they're not being bold, they're being quite pragmatic, and they'll be very, very satisfied with the market's reaction or lack of yesterday based on what they actually announced. So the three core pieces, as you mentioned, were a removal of negative interest rates, but they only raised base rates by 10 basis points. I wouldn't call that bold, I'd call that very, very careful. They did officially announce the end of yield curve control, but they have still committed to continue to buy Japanese government bonds and to respond if yields rise too aggressively and volatility picks up too much. And on the subject of equity ETF purchases being suspended, perfect timing for that. Sentiment towards Japanese equities is as high as it's been in many, many years. It's a great opportunity for the Bank of Japan to step back because actually real demand for Japanese equities is pretty strong. The question will be, will they actually start running down their ETF holdings because they built up quite an amount over the last few years? Would they be an attempted seller into the market? And we'll have to wait and see on that, really. But they didn't really intimate what they would do on that. So all in all, very measured, very calculated, well telegraphed. And one final comment I would make is that Ueda during the press conference effectively said they're not entirely sure what the R-star rate is, which is effectively the neutral real rate. And indeed, most central bankers around the world continue to grapple with that. That is effectively him saying they haven't decided what their next move will be, if any at all. And so it's probably going to be data dependent from here. And therefore, I think things will be in equilibrium for the short term.
If you was to sort of put some money on it, do you think this is a one-off rate rise, or do you think it's the beginning of a sequence of rate hikes now in Japan?
If I may posit a third option, there is a chance that they make another move, but it may not be one of a series of further rate hikes. I suspect that the US Federal Reserve, even though they're keen to get cutting on rates, the data, both from a growth and from an inflation perspective, may continue to hold up for longer than they have anticipated. That then also gives the Bank of Japan room to incrementally nudge up rates again, because other central banks will be remaining on hold for a little bit longer.
Enzio, I mean, one thing I suppose we have to be clear about, this has only happened, hasn't it, as a result of the wage negotiations that we saw last week, the Shunto spring wage negotiations, and the fact that basically the unions got wages increased by more than 5%, by 5.3% on average. So now workers are actually getting positive wage rises after inflation. Without that, this would never have happened, would it?
I totally agree with you. And I think it's important to just note that the momentum of wage increases, it was up 3.6%, 2002, 5.3% this year. That represents a momentum gain of about nearly 50%, Peter. So that's a lot. And as you pointed out in your notes, it's a real gain of about 3%. Of course, a lot of that's going to go into that key economics driver in Japan, in any economy, which is personal consumption, brackets driven mainly by women, brackets closed, because personal consumption generally accounts for about 3/4 of growth. So that's going to help profits in Japan. And I think that's why the market, let's see what Mark says, but I think that's been a key reason from a macro perspective why the market's been doing so well, because of the improved profits outlook.
Mark, would you agree with that?
Yes, there's definitely a fundamental underpinning to why Japanese equities have performed well, both in terms of ROE expansion, partly profit-driven, as Enzio mentions, but also just an improving tide of sort of shareholder return policies and corporate governance measures and so on. But coming back to why the Bank of Japan moved, indeed, I think they've seen the early outcomes of some of the spring wage negotiations. Not all of the unions have reported yet, but in the region of 5 to 6%, which is much higher than previous seasons. There's also a political imperative here. The current government in Japan has very, very low approval ratings. And if you analyze why, it's because households feel a real pinch in terms of real spending power. So even though inflation by Western standards it's modest in the region of 2 to 3%, up until now, wages have not caught up with that. And that has meant that the government has wanted to keep effectively the stimulus going, but also ensure that critically wages start to pick up. Now that they have that, then you have an alignment between both the government and the Bank of Japan, even though the Bank of Japan, like other central banks, is purported to be independent. But ultimately, there are still political dynamics at play here that can influence the decision making.
So do you think the BOJ and the government has got this virtuous circle that they've been hoping for, waiting for, this process whereby there's imported inflation, corporate behaviour improves in terms of rising wages, and that in turn then boosts domestic consumption and drives markets higher as well? Are we in that virtuous circle now?
Depends on your time horizon. Structurally, absolutely not. We have to remember that Japan's population is still in structural decline. and that's a big driver to GDP growth or lack thereof. But I think cyclically, whether that's a 3, 6 or 12-month outlook, you are likely to see wage growth and CPI inflation at levels that they're comfortable with. But longer term, there's a massive demographic challenge that Japan has. And part of that is very, very low birth rates because of the lack of affordability around housing, wages not creating a quality of life that is satisfactory to younger people, but also changing dynamics in the labour force. So Japan has been a bit of a late move in this, but more and more women in Japan are pursuing careers just like their male counterparts, and that also leads to a deferral of starting families as well, inevitably. So longer term, to answer your question, I think the jury's very much still out.
So I presume this all means then that actually these wage hikes could continue in future years because there's a shortage of labour, isn't there, in Japan because of demographics?
Yes, demographics would suggest that there should be a floor to wage growth in Japan, but then there's a caveat to that, which is automation, the displacement of human labour and human capital in favour of robotics and other ways to keep costs down. So that's something which is a global phenomenon, not necessarily just a Japanese phenomenon, but you can see how that would be beneficial for corporates to pursue, even if the government would be slightly kind of unhappy with that as a dominant theme.
Enzio, what does this all mean for the yen? Because we've had a slightly counterintuitive response, haven't we? The Bank of Japan raises rates, albeit minimally, but the yen then falls 1.2% to a 4-month low.
Well, I think, again, it's because the Bank of Japan has been buying these bonds, in other words, getting bonds, giving liquidity and increasing the liquidity, the excess supply of money. And that, of course, means more yen around, means a lower yen. So I think that's actually just against the backdrop of Mark's very useful comment about the structural demographic demise in Japan. I think you're going to find a weak yen going forward precisely in order to help these exporters, and also to help prod, as you were pointing out, Peter, domestic, in other words, imported inflation. So I think that there's a double reason for this logic of keeping the yen, trying to really keep it lowish, not to have those halcyon days that we saw when it was at 90 or 100.
And I also presume traders took note of the Bank of Japan's comments where it said accommodative financial conditions are going to be maintained for the time being, so they don't really anticipate much more in terms of rate rises from here. And it's still very loose, isn't it? It's around 0%. So that would suggest that any rise in the yen is going to get quickly reversed.
Yeah, and again, I keep on coming back to this supply of money, which is not always the same as raising and cutting rates. I learned that a long time ago. So I think that the Bank of Japan, despite having lifted this yield control regime, will be more inclined to keep buying bonds, getting bonds, giving money, pushing down the price. That then thus pushing in more money into the system, and that then, of course, then boosts the stock market.
Mark, what are your thoughts about the yen here?
We posited at Manulife whether when the Bank of Japan actually moves and raises rates, could it actually lead to a weakening of the yen counterintuitively? And it was sort of half jokingly, because obviously when a bank raises rates, when other banks are standing pat, then it should help. But the reason why we thought that was it's been so well telegraphed and talked about for a very long time. But the time it comes around, it's a very modest move. And indeed, that was the case. Longer term, though, it comes down to also rate differentials. We're now going to shift back towards the focus being on the Fed and what they say overnight tonight. There'll be no rate move, but the signalling around whether there are still too many rate cuts priced in, not just this year, but next year, will be keenly watched by the market. And if that is indeed the intimation, then you would see the yen continue to weaken further from here. Putting a number on it is very hard to say. But I think the Bank of Japan and the government are quite happy with a weaker yen. It makes the currency more competitive. It allows the Japanese economy to continue to build share in export markets.
And what about Japan's $4 trillion of offshore funds? Presumably, they're not going to be repatriated with interest rates at 0%. But nevertheless, we've now got this historic shift where rates are now starting to go up in Japan. And if they did continue to go up, at some point, presumably some of that money would start to move back onshore into Japan, which would then have some quite significant impacts, wouldn't it, on global financial markets?
Yes, but I do think that we're a long, long way away from domestic rates being competitive and sufficiently attractive to capital to see that migrate back domestically.
Yeah.
We have to remember that the base rates in the US are in excess of 5 percentage points, where we're still at 0 in Japan. That's still a very, very handsome spread, and the carry trade is still very much live and in action.
Enzio?
Peter, I think also that the key point is perhaps not the rate differential, as Mark was just suggesting, but in fact, and he wasn't just saying, in other words, it's not so important for the exchange rate, but I think it's more just the direction of the stock market. And to my mind, the economic clock is ticking just fine for Japan, this virtuous circle. So some of that offshore money might come back to get into the stock market, but not on a currency base, but on a stock market basis.
Okay, well, let's turn our attention to the US because the FOMC has begun its two-day meeting to decide interest rates. It is expected to keep borrowing costs at their current 23-year high, which is in a range of 5.25% to 5.5%. What is interesting is that markets have now moved in line with the Fed's thinking, which is for 3 interest rate cuts this year. But I presume, Enzio, really this is not about this meeting. It's about what's going to happen in future meetings, isn't it? And the indications we get from them, from things like the dot plot and what Jerome Powell says in his press conference after the meeting.
Yeah, I think it's also just keeping an eye on the Fed's preferred policy rate, which we discussed last week. As I've understood it, the Fed does not really look at the CPI, that 3.2% that we had in February of this year. It actually looks at the the personal consumption expenditures price index. And that in January, the latest reading was 2.4%. That's only 20% above the Fed's target of this indicator's 2.0%. So I found the markets have been a pretty sort of misleading indicator of what's going on, what's to happen, and perhaps because they've been staring at the wrong headlight. So if my view is at all correct, then I think we will find sort of come June, the rates starting to get cut just because the per capita, this personal consumption expenditures index continues moving south. We'll get the next reading on the 29th of March, and that will be for the February data of this personal consumption expenditures price index.
And of course, the markets have been fantastically wrong at one stage. They were betting on 6 or 7 quarter-point rate cuts by the end of the year.
I don't know how much of that was being driven by algorithmic trading. Maybe Mark can give us an erudite comment on that.
Well, I think late last year, Powell sounded quite dovish, and people perceived that to be a sort of pivot, and that led to an initial rallying in government bonds and a fall in yields. And then on the subject of algorithmic trading, bond trading is very much a momentum phenomenon. When you start to gather pace in one direction, the shorter term trading strategies, whether they're CTA, trend or macro strategies, tend to really exacerbate the moves, the magnitude of the move. So we definitely saw some short term directional flows play onto that initial rally in rates. Fast forward to today, the positioning is to some extent for lower yields, and therefore there's a bit of an asymmetry in the market for CTA macro positioning. But the point is that indeed markets were ultimately ending up on the wrong side. The Fed has served as an anchor, and the market has come back towards the Fed's dot plots. I think that the next challenge will be, as we approach the middle of this year, what happens to 20 for 25 rate cut pricing. I have a feeling that will be the next target in the central bank's mind in terms of trying to move the market's expectations away from where it currently sits. But they'll be quite happy with where things stand now. I think 3 rate cuts still sounds realistic for 2024, so long as they can start by July of this year, because they don't want to get too close to the election and they're still cutting rates, because then the accusation would be that there's political interference.
Do you think the Fed may be even rethinking a June cut now, because we had that double dose of hotter than expected inflation data last week, didn't we, on the PPI and the CPI? We're going to get the dot plots coming after the meeting in the early hours of tomorrow morning. Do you think we might see a shift downwards in the dot plots to maybe now just 50 basis points of cuts rather than the 75 basis points we've been seeing up to now?
Well, 75 represents a median view, doesn't it, of the dot plot? There were people that had voted for 1 or 2 cuts in the prior dot plot. So it's not as if it's completely out of the realms of possibility that might be where the centre ground ends up. All it would take would be 2 or 3 voters to shift from 3 to 2. But then they'd be probably quite keen to not make that an overly dramatic message to the markets, because they would still echo what we're also thinking as well, is that they're ultimately data dependent and they don't have a great deal of visibility on inflation dynamics beyond the next sort of 3 months. One thing which is starting to emerge is that inventories have been run down, particularly in the retail part of the economy. You could see some inventory rebuild boosting GDP growth in the second and third quarter of this year, which would then obviously feed back into inflation expectations again. So many moving parts here at the moment. And to come back to your original point about whether June might end up being off the table, potentially yes, but I would probably then imagine that it looks like July will be the point at which they start to move. So it probably just a deferral by 1 meeting.
Enzio?
Yeah, I think that's good common sense. I'm probably more June than July, but I mean, I'm not sort of into this day-to-day stuff. I, again, just would say that one has to always just keep an eye on this 29th of March when this personal consumption expenditure price index is released by the Bureau of Economic Analysis. It's not a headline figure, but in my mind, it's a very important Fed policy figure.
Mark, do you think Treasury yields, they jumped last week, didn't they? The 10-year was up 24, 25 basis points. Are they now at a level where they're becoming a headwind for US equities?
No. On the contrary, I think equities have proven to be very, very resilient in the US. Some of that is fundamentally driven. We had a good earnings season, particularly for the large cap tech stocks. We're now back into a window where share buybacks are permissible. They're not in blackout, so that provides a technical and mechanical bid for equities. And the thing to watch is really real yields. Now, they did creep towards 2%, which in the past has been a bit of a tension point for equities, but it's not so much the level, it's the speed of the move. And yes, there was a nominal yield move of 20, 25 basis points over the previous week or two, but in real yield terms, the move was slightly more modest because inflation break-evens were picking up as well. So I think that at this level, and with the kind of rate volatility that we've seen, equities have proven that they can digest that so long as the economy is humming in the background.
Okay, now I want to read you a letter, an email, I should say. So old-fashioned, isn't it, talking about letters? An email these days from one of our listeners.
A postcard.
Yeah, a postcard with a stamp from Cyrus Cuthbertson, who I believe is in Hong Kong. And he writes as follows. If you do want to send an email, you can even try and send a letter as well to peterlewismoneytalk.substack.com. It says, Dear Peter, in a few recent episodes, if I understood correctly, you've mentioned that the Fed is buying treasuries and releasing liquidity into the market. And Enzio made a remark that he agreed and that the Fed has increased the cost of money but has not reduced the supply of money. And several months ago, when you had John Greenwood on the show, he claimed that high inflation would remain until excess money supply had been reduced. Please could you expand upon this topic in one of your shows, perhaps by sharing some figures about the money supply levels, etc. And that should help shed some light on asset bubble creation due to excess money supply and the further path of inflation reduction in America. That's from Cyrus. Okay, Enzio, do you want to have a go at that?
Yeah, I used to work with John for years, servicing him from Smith Newcourt and Warburg as their economist. So I'm well aware of his mindset, which is very much money supply driven. And I'm not disputing that too much money chasing too few goods is not good. But I think from a market perspective, my economic clock that I've developed since 1994 really focuses on liquidity, which is the excess supply of money. And whilst the money supply M2 on an annual basis is contracting, so I've seen the excess supply of money, the actual liquidity in the system, that is, according to my sources, still pretty high, this liquidity. And that's, of course, if there's excess supply of money, that's what drives the stock market. It's not the money supply per se, but the excess money that is excess to the requirements of the real economy. So that would be my response to your listeners' very intelligent query.
Mark?
Well, I make a slightly different point is that when money market rates are in the region of 5%, we've seen a big push into money market funds by investors, both retail and non-retail, in the last 6 to 9 months. If you're generating a nice interest income of 5% on your balances, that is also a contributor to ample cash balances at the household level and at the corporate level as well. So that is also a liquidity generating phenomenon. So that's one positive. We always talk about what the negatives are of high and rising rates, but that's one positive, which is that also feeds into risk appetite as well, because people see their cash balances working quite well for them in the background.
And we also have the US government, which is issuing a lot of debt, isn't it, to fund its budget deficit, which the Fed goes and buys, and then that ends up in the banking system and eventually in the markets. Presumably that's another source of liquidity.
Well, particularly given that a lot of the debt issuance has been via treasury bills rather than treasury bonds or coupons, that's been a conscious decision by Yellen in order to mitigate the pressure on bond markets via a wall of supply. Now, I would say that longer term, whilst the yield curve is inverted in the US, she's basically doing that, but at the cost of having a higher cost of borrowing, because obviously further out the curve you go, the lower the yields are, because front end is higher yielding than the longer end. So she's effectively laying on more interest expense for the US government, but at the same time ensuring the bond market volatility remains quite under control.
Are we seeing, we seem to be seeing global liquidity everywhere in all sorts of asset classes, don't we? Not just in US stocks, but in European stocks, in Asian stocks, in Bitcoin, in gold. Are we sort of in really basically very loose territory? The Fed says, monetary policy is quite tight, but the way markets and asset classes are reacting, it doesn't seem to suggest that, does it?
I've learned really through the British School of Experience that the price of money is not equated with the quantity of money. It's a bit of a different animal. So we normally say, well, when the Fed's raising rates, it's tightening. Well, actually, it only began, in my mind, tightening as of about April of last year. So I think that, but the Fed funds had already been moving up quite a bit since then, before that. So I think one just wants to keep that one in mind, that, and obviously the central banks are not removing liquidity so much, and that means that there's a lot of this excess stuff around that's going into the market. So I'm on this excess supply of money is around despite rising interest rates.
Mark, how do you explain so many asset classes, equities, gold, Bitcoin, all surging to record highs at the same time?
It's a really good question. I always try to point out to people that the focus being exclusively on monetary policy is actually not the best approach at this current point in time with the new regime that we're in. Look at fiscal policy as well. It's extremely loose in the US. We're at very, very high deficit levels. If you look at the federal budget's office projections for fiscal deficits for many, many years to come, it assumes fiscal deficits being much higher than they have been for the last 10 or 20 years. And that also understates the likely need for increased defense spending in the US as well. So fiscal stimulus is very strong. Fiscal policy is very, very easy. So even if monetary policy, if you make the case, say it's somewhat tight, then you put the two things together, you still have easy financial conditions. And that's partly going to explain why there's strong performance across a range of asset classes. The other thing I would highlight as well is that there's an acute shortage of US dollars in global funding markets, particularly if you look at China, for example. There's a lack of dollars within the system. And one way for people to gain access to dollars is to build up holdings in gold or Bitcoin, because they're denominated in the US, and when they sell them, they get US dollars back. So it's a way to circumvent the constraints that are currently being imposed by the US Treasury on overseas supply of US dollars.
And does this also explain then, as well as explaining why markets in the US, Europe and Asia are record highs, does it also explain why Chinese markets are way off their record highs? Because on the mainland, maybe fiscal policy is too tight. The market seems to be calling out for it to be loosened, but the authorities seem to be very reluctant to do so.
I think that the reality is that the ability for the central government to enforce local governments to effectively be issuers of debts and to fund traditional sources of fiscal stimulus, whether it's infrastructure projects, the capacity for local governments to take on more debt now is much more constrained than it was in the past. So there's a lack of ability to stimulate in ways that we saw, for example, in 2009, 2010. The other point as well is that the central government in China is not that keen to effectively unleash spending power and spending autonomy into the private sector and into households, because it would see that as going against the grain of increasing centralization and effectively marshalling of the economy from the center. So there's a political shift in appetite as well as a fiscal constraint at the local government level in China.
Enzio, final thoughts from you?
Yeah, no, I fully agree with Mark, especially this party, the centralization of the especially of the parties increasing control over the direction of China. That's a very important political trend that I am afraid is perhaps leading to the Japanization of the Chinese economy. That's my own view. And then, of course, you've got the fiscal side with the constraints of the local government debt rising a great deal. So I agree with Mark.
Okay, well, thank you both very much. Fascinating discussion this morning. You heard there Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management in Hong Kong.
Peter Lewis's Money Talk.
I'm joined now by Tokyo-based journalist and author William Pesek. Morning, William.
Good morning, Peter.
Well, an interesting day for the Bank of Japan, wasn't it, yesterday? We were all wondering whether they would raise interest rates. They did, albeit marginally, but they sort of went all in, didn't they? They ditched yield curve control and ETF purchases as well at the same time. Why have they done that?
Well, I think that in some ways they felt like they had to move. I think in many ways markets led the BOJ to this conclusion. I think in many ways, I think the BOJ realized that given the fact that they've been holding off on this tweak for a very long time, markets had in many ways built in the expectations that they would move. And I think that in some ways, markets in some ways prodded the BOJ to make this this somewhat, I'd say, confusing change in policy. Why I say confusing is because the yen is actually weaker right now. So if the BOJ raised interest rates the way markets are, the way that certainly the news media is suggesting, why is the yen falling? I think what we're seeing here is a kind of rate tweak that's been lost in translation in certain ways. We've seen the BOJ scrap yield curve control. That's significant. The BOJ changed the target for the overnight deposit rate slightly, but in many ways the yen is already weaker. So markets are already looking at the BOJ saying, okay, nice, what's next?
I suppose it's slightly odd, isn't it, in that the BOJ has moved to raise interest rates as the economy is weakening?
Yeah, and in some ways it is odd, but I think one of the things we're seeing is with the stock market going gangbusters. I think there's this interesting split screen between what you're seeing in the economy and in the global headlines about Japan. What we saw, say, in January was that retail sales fell 6.3% year on year, which was the biggest decline since the height of COVID. And so in many ways, you're looking at an economy that is not entering 2024 on very strong footing, and the BOJ making this tweak. So if you're Prime Minister Kishida with approval ratings around 20% and you're worried about the economy's trajectory, you probably aren't very happy today that the BOJ is tapping on the brakes to some extent.
How significant is it? I know in some ways it is historic in the sense that we've had negative rates in Japan since 2016 and the Bank of Japan hasn't raised rates since 2007. But then at the same time, interest rates have gone from minus 0.1% to 0%. So it's hardly a huge move, is it either?
Right. I mean, in many ways, this is the BOJ sort of clearing its throat and saying, pay attention. And I think the question now will be where the BOJ takes things in the next 3 to 6 months. I think every speech you see from a BOJ official in the next several weeks is going to be scrutinized very, very closely. I think the fact that the BOJ made this move, but they also stated that accommodative financial conditions will live on. I think we're seeing some mixed messaging. That's why I said earlier that I think things have gotten lost in translation to some extent. I'm thinking of this as kind of a tightening move, right? So they sort of did the bare minimum in certain ways, and markets are already saying, well, we're going to send the yen lower. What's next?
So is this a one-off rate rise rather than the beginning of a sequence of rate hikes?
Well, I think it really depends on what happens with the economy in the months ahead, but also it depends on a couple of other variables. In many ways, BOJ policy has been made in Washington in recent years, and I think the BOJ is watching to see what the Federal Reserve does very, very closely. They're also watching China. China's economy continues. I mean, China certainly is not flatlining, but from the standpoint of Asia looking for an economic engine, China certainly is disappointing at the moment. And for Japan, being that China is Japan's largest trading partner by far, that's a concern. So I think that the BOJ is looking at the external scene. They're looking at domestic demand, which is not very, very strong. And I think they'll take their cues from that. I do not expect radical rate hikes in the weeks and months ahead, but certainly the BOJ has cleared its throat and said we are certainly pivoting in a more restrictive direction.
This wouldn't have happened, though, would it, without the wage negotiations, the Shinto wage negotiations, where the unions got over 5% wage increases for their members. So it's basically put their wage increases into positive territory now after inflation.
Exactly. And I think one of the problems that the BOJ is facing is their target is 2% inflation. A lot of the inflation Japan has had to date has been imported from overseas, from higher energy and food prices. And suddenly the Japanese worker is getting the raise that he or she has been hoping for years now. And this, I think, also did pressure the BOJ to take this step, because I think that there's a recognition that the level of reform at the government level has been kind of underwhelming as well. And if you believe that a wage increase could be inflationary without productivity gains, that could be a concern. So what the BOJ did yesterday, I think, was a rational response to changes not only to the external scene, but also what's happening domestically here in Japan.
The BOJ is taking a bit of a gamble, though, isn't it? Because it does need to see those wage gains continue, because those Shinto wage negotiations were with big companies. And of course, the vast majority of the Japanese economy is dependent upon smaller companies, where it's much harder to raise wages. So if these wage gains don't broaden out and continue as well, the BOJ is going to be in trouble, isn't it?
That's an important point. I mean, about 85% of employment in Japan is small to mid-sized companies, most of which are not unionized. So the Shinto wage increase doesn't technically apply to them. The government is hoping that the shame factor will prod companies, smaller companies, also to give workers this kind of raise increase. But you're right. The BOJ has to be very, very careful here. The balancing act is to step away from quantitative easing very, very slowly in a way that doesn't panic the corporate sector and give CEOs of small to mid-sized companies reason to not increase wages in the months ahead. So you're right. This is quite a balancing act. And if anyone tells you very decisively they know what will be happening in Tokyo in the next 3 to 6 months, they're lying, because I don't think even the BOJ understands where they'll be 6 months from now.
I suppose that the demographics, though, are in favour of continued wage increases, aren't they? Because there is a shortage of workers at the moment, and you're not getting enough people coming in from overseas either. So that there is an overall shortage of workers, which suggests that companies are going to have to pay more.
That is true. I mean, one of the trends that companies have been riding to, in some ways, offset that particular dynamic is they're moving more and more workers to what they call a non-regular employment. So they're moving a lot more workers and hiring more workers on what you would call short-term contracts, which pay a bit less. So that's one of the ways that companies are trying to depress wage increases. But you're right. I mean, in many ways, Japan is sort of the dog that caught the car in certain ways. Certainly we have wage increases. We certainly have workers demanding higher wages, and we'll see how things shake out in the months ahead. If you're BOJ Governor Ueda, you're going to have a very, very busy year.
Now, what does this all mean for the markets? We've had an interesting response, didn't we, yesterday? The markets obviously closed today, but yesterday, first of all, the yen, the Bank of Japan's raised rates, but the yen fell 1.2% to a 4-month low.
Well, markets have kind of shrugged, haven't they? Which is interesting. I'm a bit surprised by the lack of response in markets. And I think in some ways, the markets have realized that the BOJ yesterday did the bare minimum in some ways it could have done. And they're taking solace in that no radical changes are coming. But I do think in many ways, if you are in the stock market, you look at the Nikkei is up about almost 50% in the last 12 months, and the BOJ is beginning to raise interest rates at a moment where Japan might be in a technical recession. You're taking a deep breath, you're looking around, and you're saying, well, where are things headed? No one knows.
And I suppose that even after this rate rise, the yield differential between Japan and the US is still very high, isn't it? And it seems unlikely that the Fed is any rush to cut interest rates. It certainly doesn't seem as though it's going to do them tonight at its meeting. So we're still left with a very wide yield gap, which doesn't favour the yen.
Exactly. I mean, and the Fed's lack of pivot this year, I think, has surprised many in Japan. I think a lot of investment banks here were convinced the Fed would be cutting rates 3, 4, 5 times this year, and they're scaling back those expectations. So I think that's partly why I said earlier that I think in many ways BOJ policies are being in some ways made in Washington, D.C., and they're keeping a very, very close eye on where U.S. rates are headed.
And what does it mean for stocks? Obviously, the Nikkei 225, quite yen dependent, isn't it? Because of all the exporters in it. Is a weak yen going to be good for stocks going forward?
I think that's one of the reasons why the BOJ also is somewhat worried about taking a drastic step, because the last thing the BOJ wants to do is be the spoiler here. The last thing they want to do is be blamed for killing Japan's best bull market in stocks and generations. And so that's part of their balancing act.
I suppose the Bank of Japan also, it's got some history here, hasn't it, of moving too fast to raise rates, only having to go and reverse it again later on when it killed off the economic recovery.
Exactly. Back in 2007, we saw that when the BOJ managed to raise rates twice between 2006 and 2007, and Japan fell into a technical recession. And so that is certainly one of their concerns. I mean, will the corporate sector, will the household sector take this step towards monetary restraint, if you will, badly? We'll see.
And there's a lot of money offshore, isn't there? About $4 trillion of offshore funds, Japanese offshore funds. At what point do investors start thinking about repatriating that?
Well, I mean, that is one of the big questions. I mean, you have seen Japanese investors venturing overseas, increasingly even to India these days. And will a lot of that money be repatriated back? That is the big question in the months ahead. And I don't know any better than the average investor or BOJ official how that will shake out. But certainly capital flows will be very, very much in we'll be examining those very closely.
I mean, I have no idea either, but all I do know is that when it does start to happen, that's going to have some major implications for global markets.
It will, indeed.
William, always a pleasure to talk to you. Thank you very much indeed.
Thank you, sir.
That's Tokyo-based journalist and author William Pesek.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Econosis Advisory, and Tony Nash, founder of Complete Intelligence. With a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting in Taipei. See you tomorrow.
Money Talk